Yeah, no, I think JP Morgan and PNC are much more indicative of what we could expect next week than what we saw from Wells Fargo that's dealing with a lot of company-specific issues. But generally speaking, you saw, modest net interest income growth. Loans grew year over year. Margins still expanded a little bit. You saw very well-controlled expenses and positive operating leverage. Fairly benign credit quality metrics, so non-performing assets starting to tick up a little bit on the commercial side, but from low levels, and just very active share repurchase. So a lot of the themes that we saw, throughout the last couple of years kind of continue into the first quarter of this year.
Jason, are some of the analyst community sort of angry at Wells Fargo because it's a significant cut to the guidance that other banks haven't had to do so soon after Wells Fargo issued that guidance?
Certainly it's been a frustrating story. Ever since their sales practice issues came to full light in September 2016, it's been a long slog to kind of get this company on track. Obviously, a few weeks ago, announcing that, they will change the CEO being the most recent portion of it. But it takes a long time to turn a big ship, and they're still in the process of trying to turn this around, and it looks like it's going to take even a bit longer from here.
David, were you pleased to see that some of those reports out today, and does it make you think that this is the start of a meaningful turning point for their share prices?
Well, I think one of the things that Jason didn't mention that I think is important to mention is the improvement in the efficiencies and the other businesses that they're getting into. So I think what you're seeing is these companies are building a more predictable and a more stable earnings stream that is, I think, going to show up in valuation over time. So that's the hope. I think it isn't a growth story. It isn't a sexy Disney story. It isn't an M&A story. They've got to convince the market that they have sustainable earnings and predictable earnings to continue growing and continue to buy back and pay dividends. So I think you're going to continue to see that. And so the hope is that we can get some valuation bump, but time will tell. I think rates going up are very important. They don't need to go up a lot, but the fact that rates reversed a little bit and presumably the recession that happened in December is now over has been very positive for this group.
I just feel like, Jason, that's the key right there. We get all of this information from the banks, and most of it looks better, and then, the ECB eases further into negative territory, or the Bank of Japan does, or even Fed cut odds, which are now 50% for December, go up. These macro factors just weigh on the banks. How much is that going to be offset now that we're getting results like this, or not?
Certainly banks are a reflection of the economy, and the economy grows, banks follow, and the opposite of that is true. But even in an environment where revenue growth has been modest, they've been able to control costs, fairly benign credit quality, buying back stock. So it doesn't really take a lot of revenue growth to get some pretty good earnings growth, and I think that's one of the things that you're seeing, this quarter as well. And mind you, these banks are very, very geared to the U.S. economy, which continues to outperform, the non-U.S. markets.
David, if you had to pick out one of the big six as your top pick, which would it be?
I still think Bank of America is the best choice. I think I love JP Morgan, but I think Bank of America has more upside. They got more things to get better, and I think they represent more of the economy, and they've got great exposure to the consumer, and I just think it's underappreciated as a franchise in America.
Jason, quickly, same question to you of the big six.
Yeah, going into the quarter, JP Morgan, was our top pick, and we didn't see anything today that would, cause us to revisit that.